earnings at the start, and also the equity share capital also at the start of the year. So we have some additional information, number 1, all the way to note number 7. So what are we required to do here? We're required to compute the gain or loss on the disposal of shares in S Limited on 31st of March 2017. And basically, Roman 2, we are required to prepare the consolidated statement of comprehensive income for the same year. That is the year which ended 31st of March 2017. So automatically, the first thing we need to do here is we come up with a group structure. We need to come up with a group structure. And also, we need to know the date when the parent company sold shares which were held in S. Because I hope you can see, as per the requirement, we're required to compute the gain or loss on disposal of S Limited. So the parent company sold shares in S Limited. So where do we have information about the group structure? Let's go to note number 1, and you're told W Limited bought 60% holding in the equity shares of S Limited on 1st of April 2016. So W Limited here acquired, in other terms, it bought 60% of the equity shares in the company which is called S Limited on the 1st of April 2016. 1st of April 2016. And then you're told the purchase consideration was agreed at 900 million, of which 600 million was to be paid in cash. The balance was satisfied by immediate issue of 5% board at par. And then you're told S Limited net asset had a fair value of 1,400 million as at 1st of April 2016, represented by equity share capital of 775 million, retained earnings of 625 million. It was decided to apply the proportion of net asset method in to calculate the goodwill on acquisition. So no impairment loss on goodwill arose during the year. So that when computing the goodwill on acquisition here, we are told we are going to use the proportion of net asset method. So if that is the case, which method are we going to use in computation of goodwill? The full goodwill method or the partial goodwill method? We are told to use the proportion of net asset method. Yes, in this case, we are going to use what referred as the partial goodwill method. Partial goodwill method. Remember, I say that in an examination setup, the examiner will not tell you specifically which method to use, but you can be told that on the date of acquisition, the NCI, for example, is measured at fair value. In that case, we said just use the full goodwill method. So you can also be told that the NCI will be measured at their proportionate share. Proportionate share over fair value of net assets. So if you're given that information, for example, that is what you're told in our questions here, then you use which method? The partial goodwill method. Remember, you said the partial goodwill method, we only compute the goodwill of the parent company. The goodwill of the parent company. Now, equally, we are told that goodwill was not impaired. We will come back to that. Then let's move to point number 2. And you're told W Limited sold its entire 60% equity holding in S on 31st of March 2017 for shillings 1150 million. So before we go to that point, I want us to get information about the date where the other company was acquired, because I hope you can see we have how many companies here? We have 3 companies, W, S, and F. So we also need to get the information about the date when the other company was acquired. When the other company was acquired, and someone is saying Modimo's video is not clear. Modimo's video is not clear. Was it like that? Okay. Okay. Yes, I'm getting some message on my screen that my internet is not stable. So sometimes the internet tends to fluctuate, and that automatically affects the quality of the video. Here is that before we consider the information about the disposal of interest in note number 2, we need to get information when the parent company acquired the other company, because you can see we have 3 companies. We have W, S, and also we have F. So where do we have information about the acquisition of F? So we have that information in note number 3. And basically, note number 3, we are told that W Limited owned 90% of the equity shares of F since its incorporation. No goodwill which arose on the acquisition of W owned 90%. Okay. No goodwill which arose on the acquisition of on the date of acquisition, there were no retained earnings in existence at the acquisition date. So basically, we are told this company here acquired 90% of the equity shares in the company, which is called F Limited, since this company was incorporated. Since this company was incorporated, actually, we are not given the specific date of payment there. And then you're told there was no goodwill which occurred on the acquisition. And equally, this company didn't have any retained earnings simply because at the date it was acquired, it was basically a new company. So basically what that means is that this will be the parent company there that equally is a subsidiary that is also a subsidiary. And then if you go to the requirement, first of all, before you go back to note number 2, if you go back to the requirement, you'll basically be able to see that specifically in Roman 2, we are required to prepare the consolidated financial statement for the year which ended 31st of March 2017. Remember, this is the date of consolidation. So when did our financial year started? So automatically the next year we start 1st of April. So this year started 1st of April 2016. That is when the year started. And therefore you can see this company here that is S was acquired exactly at the start of the year. So having that information, but automatically this company was not acquired during the current year. It was acquired some time back at the date it was incorporated. Sasa? Yes. Let's go back to the information we have in note number 2, because in that note we are given information about what? We are given information about the disposal of interest, or basically disposal of shares, shares in this company, which is called S Limited. Now we are told in note number 2, W Limited sold its entire 60% of the equity shareholding in S Limited on 31st of March 2017 for shillings 1150 in cash. No entry has been made to reflect this transaction. Now, what is important to note here is that this company here, that is W, we are told it sold the entire shareholding. So entire shareholding means that this company here sold all the shares held in this. So basically, this therefore is basically a full disposal. Is a full what? Disposal. Now, if it is a full disposal, then record what we said. This one should be accounted for in accordance with what? In accordance with IFRS 5. What does IFRS 5 state? IFRS 5 requires that when this company is preparing, the parent company is preparing the group accounts, the parent company should classify the operation of the group into 2. The discontinued operations, and then the continuing operations. Now, this subsidiary which has been fully disposed, we say it is actually known as discontinued operation. Discontinued what? Operation. Whereas now the parent and basically the subsidiary here shall be regarded to be the continuing operation. So therefore, when preparing the consolidated statement of a profit or loss, we said first of all we have to determine the profit or loss for the year from the continuing operations. From the continuing what? Operations. Continuing operations, basically what we will do, we will take the revenue of W plus that of F. We will not include that of S because it is a discontinued operation. And then we take the expenses, those of W and those of F. And then from there, what we will do down here, we will get the profit or loss from still continuing operations. From continuing what? Operations. Then from there, we come down here and we show the results from the discontinued operations. Discontinued operation is basically the subsidiary which was fully disposed. What do we consider here? We consider 2 items. One, we will determine the gain or basically the loss of disposal in the normal way. Is basically a result from discontinued operation. And then, because this one you can see as per note number 2, I hope in note number 2 you can see the date of disposal. It was disposed exactly at the end of the year. So the parent company had 60% shareholding in S for the whole year. So what we will do, we will compute the profit or loss of this subsidiary here. Basically, that one will be computed by taking its revenue for the whole year minus expenses for the whole year. Minus expenses for the whole year. If we get a positive figure is a profit, if we get a negative figure is a loss. The same case here, we will have a gain which is a positive and a loss is what? Is a negative. And then from there, we will basically get now the profit for the profit for this group for the whole year. But basically what is important here is that when preparing this consolidated statement of profit or loss, simply because this subsidiary has been fully disposed, it is regarded as a discontinued operation. And therefore, when preparing this, we need to prepare that in compliance with IFRS 5. Don't combine the results of the parent and those of F with this one. So because these are continuing operations, these are discontinued operations. The profit or loss from discontinued operations must be shown separately here. I think there is a question for cash flow, which is there in the past papers. And I think we were able to look on that question and take into account the parent company had fully disposed one of the subsidiary. This is how the income statement was presented in compliance with IFRS what? 5. Sasa, yes. So that is basically what is important as far as that is concerned. So coming back here, we are told that this particular subsidiary was actually disposed at the end of the year. Remember, you said the year started 1st of April 2016. So this when the subsidiary was acquired, and actually this is the date of disposal. The date of what? The date of disposal. It was disposed exactly at the end of what? At the end of the year. So remember, we say that anytime the parent company sells shares in a subsidiary, and basically the parent company loses control, we have to compute the what? We have to compute the profit or the gain or loss on disposal. And I think that is what we required in Roman 1. Let's first of all, we go straight to that. Then we will go through the additional information as we make the necessary adjustments. So we compute the gain or the loss on disposal of our shares in what? In S Limited on 31st of March 2017 or 31st of March 2017. So we just need to recall how we compute this. This is something we did in our previous class. How to compute the gain or basically the loss on disposal, the gain or the loss on disposal. The gain or the loss on disposal. So how do we compute this? Remember, in this case, we should have one column here, just a single column, and our figures are given in million of shillings. So here we start with the fair value of our purchase consideration, which was received. Always this one will be provided by the examiner. So to this we add the fair value of the investment retained, which was retained. In this question here, do we have any investment which was retained? Is there a full disposal? Elizabeth, do we have any investment which was retained here? Any investment which was retained? No investment which was retained because it is a full disposal. It's a full what? Disposal. No investment which was retained. And then to this we less the parent company. The parent company and impaired goodwill. The parent company and impaired goodwill. And also we less the fair value of net assets at date of disposal. At date of what? At date of disposal. At the date of disposal. The date of disposal. I think we can start by determining this one. The parent company and impaired goodwill. Where do we get information about that? We will compute the goodwill on acquisition of S from the information we have in note number 1. Note number 1. Let's go back to note number 1. And basically we compute the goodwill on acquisition of S Limited. So, and remember, as per note number 1, this goodwill will be computed using the partial goodwill method. The partial goodwill method. That's basically what you have said. So, how do we compute this goodwill? We start with the purchase consideration which was paid by the parent, which we said can also be known as the cost of investment. Purchase consideration which was paid by the parent company. And basically we have that in note number 1. So how much purchase consideration was paid by the parent company? As per the information we have in note number 1. As per the information we have in note number 1, the purchase consideration was 900 million. 900 million. But that one, I think, was split into cash, into both. So basically what is important here is to take the total. The total purchase consideration is 900 million. And then to this, what do we less? We less the fair value of net assets acquired, fair value of net assets acquired, fair value of net assets acquired. And I think we also have this value here. We are told in the same point number 1, and the net assets had a fair value of 1,400 million at the date of acquisition. So meaning that at the date this company was acquired as limited, the fair value of its net asset was 1,400 million. And actually we are told that this one comprised of share capital. It's comprised of equity share capital of 775 and basically retained earnings of 625. So automatically if you add these two, 0, 0, it will basically give us what? 14. It will give us 14. So, and because you're using the partial goodwill method, we are interested with the net asset acquired by the parent. The parent company acquired 60% of the shares. Equally, the parent company acquired net asset equal to 60%. So the net asset acquired by the parent should be 60% of this. 60% of that, which will give us what? Which will give us 840. 840. 840, is that correct? Yes, 840. So meaning that the goodwill on acquisition is how much? A 60 million. A 60 million. So we need to check, was this goodwill impaired? Because what we consider here is the original goodwill minus any impairment loss. I think there is something we are told in relation to note number 1, the last sentence of note 1. We are told no impairment loss on goodwill, which are lost during the current year. So this goodwill was not impaired. So basically what we consider here is the parent company unimpaired goodwill. The parent company unimpaired goodwill is how much? 60 million. So that goodwill was not impaired. Tuko pamoja up to that point? Yes. So now what we need to do basically is we move and we determine this. Are we given the fair value of the net asset at the date of disposal? Remember, like the other question which we did in our previous class, the examiner had not given us the fair value of the net asset of the subsidiary which was disposed. And I hope you can be able to recall how we computed that. We computed that by taking the share capital of that company plus the reserves, because we said in group account, when computing the net asset of a subsidiary, take its share capital plus the reserves. Basically, if you go to the information note number 3, because that's where we're given, yes, I think we needed to record that one. We have it in note number 3, purchase consideration. We are told in note 3, W Limited, okay, W Limited, note number 2, not note number 3. Note number 2, we are told W Limited sold its entire 60% equity shareholding in S on 31st of March 2017 for 1150 million. So this is the purchase consideration which was received. Purchase consideration which was received there, 1150. So, and then you're told in cash, no interest had been made to reflect this. So in that case, you can see on the date of disposal, we are not given the fair value of the net asset of S, because that is what we need here. Maybe you can check that. In note number 3, we are given information about the acquisition of this. Note number 4, let's go to note number 4, we see what you're told. We are told during the year which ended 31st of March 2017, W Limited sold some goods to F. This is basically intra-group sales between W and S. Does that, or are we given information about the net asset of this on the date of disposal? No. Note number 5, we are told on 1st of March 2017, F Limited declared interim dividends. Okay. We have the interim dividends which were declared. Then number 6, we are told all expenses and gain are assumed to accrue evenly. And then you're told the interest on 5% both are payable in arrears. No payment had been made or provided for. Okay, I'll be able to explain why we given that information. I'll be able to explain that information. Now, in this case, therefore, you can see we are not given this particular value here. We are not given the fair value of the net asset of this company at the date of disposal. How do we compute that? We will compute this one by taking the ordinary share capital of this company plus the various reserves. Plus its various what? Reserves. Now, if we go back to the information we have in paragraph 1, we know that this company was acquired at the start of the year. And when it was acquired, it had the net asset, or the fair value of its net asset was this one, was 14. And actually this 14, remember, we're told that this comprises of share capital, this equity share capital of 775, and basically the retained earnings of how much? Of 625. 620 what? 5. Automatically, to get now the net asset at the end of the year, we will take this and then we will add what? The profit for the year. The profit for what? For the year, and maybe any other reserve. because I think in that income statement, there is some gain on the devaluation. Remember, whenever an asset devalue an asset, that is a reserve. So basically, reserve should also increase the value of its net asset. Yes. So can you give me the profit for the year for S? What is the profit for the year for S? Profit for the year for S ni ngapi? From automatically we get that from the income statement. Profit for the year for S. This company reported a profit of how much during the current year? The profit reported by this company during the current year. Yes, the profit reported by that company during the year, ni ngapi? Ni 90. Is basically 90. So we add the profit for that year because that will increase the net asset. Remember, the net asset at the start of this company is 14. Is that what we're interested with? No, we're interested with the net asset here at the end. To compute the net asset at the end, we will take the net asset at the start, which basically we know comprises of equity share capital plus the retained earnings. So to get the net asset here, we will take this amount, but basically we have to add what? The profit for the current year, because that will automatically increase the retained earnings. Number two, you can also see that this company revalued some items of PP. Now, once a company revalue an item of PP, remember that forms part of equity. Is that the position? If a company revalue asset upward, that revaluation gain becomes part of equity because that is a revaluation reserve. Is that the position? Is that the position? Is this part of the equity? Is that part of the net assets? Automatically, yes, because it is a revaluation reserve. So therefore, the net asset at the end of the year will be 14 plus the profit for the year plus what? Plus now the revaluation gain or the revaluation reserve. This will give us an amount of how much? This will give us an amount of how much? 15 what? It will give us 1502. So it basically means that the net asset of this company at the end of the year, the net asset of this company at the end of the year is what? Is that particular amount. Is that particular what? Amount. Tuko pamoja? Yes. And I hope you can see we have done the same thing. Only that the other question which we did, it becomes part of equity. So therefore, at the date this company was disposed, the fair value of its net asset was 1502. So in this case, are we supposed to consider 100% or we said we take what here? Are we supposed to take 100% of this? Or which percentage are we going to work with? Yes, in this case, we said we take the parent company share. The parent company share of this net asset will be equal to 60%. Will be equal to 60%. That is basically what we work with. So that will give us what now? That will give us what? That will give us what? Yes, that will give us 901.2. 901.2. And basically we are done. So what we need to do is we determine the gain or the loss on disposal. So we have 1150 minus 60 minus 901.2, and basically that will give us what? That one will give us 188.8. So this is basically a positive figure. So this is what? A gain on disposal. That one is a gain on what? A gain on disposal. Gain on what? Disposal. So that basically what was required. The marks allocated there are 4. I think 2 marks will go to that. 2 marks will go to that. And because of that computation, the marks allocated there are 4. Are basically 4 marks. Are 4 marks. So let's move now to the other part of the question. And basically what we are required to do is we prepare the consolidated statement of comprehensive income for this year. So let's prepare that one. We prepare that. So Roman 2, the consolidated statement of comprehensive income. Comprehensive income, which is for the year, which ended 31st of March 2017. 31st of March 2017. 31st of March 2017. Yes, 2017. Now, in this case, what I've said, when preparing this, we classify the operations of this group into two: discontinued operations and continuing operations. So this subsidiary which is predisposed, I've said, as per IFRS 5, it is actually regarded to be a discontinued operation. We will show the profit or loss from that discontinued operation as a separate line item, as a separate item here. And then for the continuing operations, that is W and F, we will basically have to compute the profit or loss from the continuing operation. So therefore, what we do here, we start by computing the profit or loss from what is known as the continuing operations. Continuing operations basically is comprises of W plus who? Plus F. Plus F limited. Plus F limited, like that. Then we have said the subsidiary which was predisposed is basically a discontinued operation. Is a discontinued operation. So let's do that. So we will start with the revenue. We need to go back to the statement of comprehensive income for individual companies given below paragraph 1. We have the revenue. So revenue, we will take that of W, which is 976, plus that of S, not S, rather F, which is basically 63. Remember, this company was not acquired during the current year. We are not even given the specific date of acquisition, but basically it was acquired some time back from the date it was actually incorporated. So we will then check whether there was any any sales between the two companies, and basically we list it there. So we also consider the cost of sales for the two companies, that is of W687, plus that of F, which is basically 26.2. We will see whether we have any adjustments. Then we will get the gross profit. So below that, we have other incomes. So other incomes, we should take that of the parent, 6.1, plus that of F, which is basically 0. Okay. Then from there, we have dividends, which was received. The dividends received is 8.1, plus that of F, which is basically 0. But automatically, as far as those incomes are concerned, the other incomes, dividends received, we said, we have to check whether there was any income received within the group. For example, did this company pay maybe some dividends? If it paid some dividends, some of the dividends were paid to W, so that is an investment income generated within the group. We said it should not be included here. And I think there is a point which I've seen in relation to that, but as we go through the additional information, we will check again. Yes, so then from there we have the operating expenses. So for the operating expenses, we take those of the parent, which is 68, plus those of F, which is basically 13.4. Okay, we need not to cross the bracket. So then from there we have the finance cost. Cost, we take that of the parent, which is basically 12, plus that of F, which is 6.2. 6.2. Yes, so then from there, we have the profit before what? Tax. So to this, then we have the income tax expense. So for the income tax expense, we take that of the parent, which is 45, plus that of F, which is 3.2. And automatically, this being an item of tax, remember we say that this one we don't have any adjustment for this. We get the final value here. This will give us 48.2. Maybe remember what you have said. We have said S Limited is a discontinued operation. Any profit or loss from this company will be shown as a separate item here. So tutakuwa na other subheading hapa, discontinued operation. This gain is a gain from a discontinued operation. Zote tutaziweka hapa, but we don't have to combine that with. What we are determining is the profit or loss from continuing operations. Continuing operations, I've said we consider two companies here, W and F. S is a discontinued operation. We should not combine that with the results of the continuing operations. Yes, that's what you have said. Then from there, we will get the profit after tax. The profit after what? After tax. the profit after tax, the profit after tax, the profit after tax, the profit after tax. So after getting that profit after tax, we should basically proceed and we add other comprehensive incomes. We should proceed and basically we add other comprehensive incomes. And equally in that case, when adding other comprehensive incomes here, we will basically take the comprehensive income of the continuing operations only. The continuing operations would only. The continuing operations only. Continuing operations only. Continuing operations only. So, but I think before we do that, remember, we should basically come here and we show now the profit or loss from the discontinued operations. Discontinued what? Operations. Discontinued what? Operations. Discontinued operations, remember in this case, we have said that this is S limited. S limited is regarded to be a discontinued operation. Discontinued operation is a component of an entity or a component of an entity which has been discontinued, which has been disposed. So this is a component of the group which has been disposed. How many items do we consider here? Two. One, we have this gain from the disposal of shares. We have the gain on disposal of our shares. So how much is it? It is 188.8. And then from there, we will go to the income statement of this. Take into account the parent company owned this particular subsidiary for the whole year. We will basically take its profit or loss for the whole year, the profit or loss of S for the whole year. So where do we get that? We get that from the income statement of S. So from the income statement of S, what do we have? Basically, that company reported a profit of 90. So we also have that here. So we will have the profit for the year. For the year, for which company? For S. For S, how much is that? Is basically 90. Is actually 90. So this basically what IFRS 5 requires, that anytime we have a discontinued operation, the profit or loss from such a discontinued operation should be shown as a separate item within the statement of profit or loss. Within the statement of profit or loss. That's basically what we have there. So then from there, we will basically have now the other comprehensive incomes. Other comprehensive income. Equally, this one you can separate this for the continuing operations and also other comprehensive incomes. Other comprehensive incomes for the discontinued operations. For the discontinued what? Operations. Remember here, we will consider the revaluation gain basically for the two companies, W and F. Discontinued, continuing operations, that is, continuing operations, W and F. So that is basically 15 plus what? Plus 2. That of W, that of what? Of F. That is basically 17. That is continuing operations. What about discontinued operation? So here we will consider the revaluation gain for W only, for S limited only, for S limited only. And basically that is what? That is 12. That is what? That is 12. That is 12. That is 12. That is what? That is 12. That is 12. Okay, so I think then we can go through the additional information. We see whether there is any adjustment to be made to that. So let's go through the additional information number one. Additional information number one was about acquisition of S. And I think in relation to that, what you have been able to determine is the goodwill. I don't think there is anything which would be affecting the income statement in relation to note number one. Note number two is about sale of shares in W. And I think you have computed the gain or loss on disposal. Note number 3 is about the acquisition of F limited. That will not affect our consolidated statement of profit or loss. Let's go to note number 4. In note number 4, we are told during the year which ended 31st of March 2017, W limited sold goods to F. W limited sold goods to F. That is basically sales between W and F. Remember, these are this forms part of the continuing operations. So the goods which were sold by W to F were 15 million. So automatically that being amount of intragroup trading between W and F, that one we eliminated from the group revenue and the group cost of sales. Group revenue and the group cost of sales. Group revenue and group cost of sales. And then you're told these goods were sold to W at a markup of 50%. And then you're told 3/5 of these goods remained in the inventory of F as at 31st of March 2017. So we need to compute the amount of unrealized profit here. The amount of unrealized profit, which is equal to the gross profit margin times the unsold goods. Times the unsold goods. So are we given the gross profit margin? We are not given the gross profit margin. So what we have in our questions here is the gross profit markup. Is the gross profit markup? Is the gross profit markup? That is basically what we have. That is what we have. Yes, that is what we have here. We have the gross profit markup. So the gross profit markup is given as 50%. 50% is the same with half. Is the same with half. So mean that the gross profit margin will be equivalent to each fraction. Gross profit margin will be equivalent to each fraction. Yes, it will be a third. So this one will be a third of the unsold goods. The unsold goods, we are told, would be 3 all over 5. 3 all over 5 of the sales. 3 all over 5 of the goods which were sold by W to S. That is 15 million. 15 what? Million. Those are unsold goods. So that will give us basically 5. No, is it 5 or 3? Should be 3. That and that will go. And that means that we have an unrealized profit of how much? 3 million. So this unrealized profit, when preparing this one, we add it to the group cost of sales. We add it to the group cost of sales. Remember, if you are preparing consolidated statement of financial position, we less that from the group inventory. And then in the last sentence of note 4, we are told amount of 4.3 million remain outstanding to W in respect of these goods. So this basic amount of intercompany debt, this one is only considered when preparing the consolidated statement of financial position. That one should be deducted from the group revenue, not the group revenue, sorry, the group receivables and the group payables. Are we preparing that? No. So no adjustment for that. Let's go to point 5. We are told on 1st of March 2017, this basically a month to the end of the year, a month to the end of the year, a month to the end of the year. So we are told F Limited, this one, declared an interim dividend of 9 million. So automatically, if this company declared interim dividends of 9 million, it basically means that 90% of this dividend, 90% of the dividends were paid to this company, which is 8.1. So automatically, this company accounted for this as an income. Accounted for that as what? As an income. That's basically what we know. So if it is accounted for that as an income, and I think that is what you can see here, this one is an income, investment income generated within the group. Should we include that in the consolidated statement of profit or loss? No. So to this, we should less the dividends received from the subsidiary, 8.1. So that means that that amount should not be recognized here as an income. It's an investment income generated within the group. That one should not be included here. And then you're told, still in note number 5, sentence 2, W Limited has recorded its share of these dividends. And then you're told no other dividends were declared by the group companies during the year. No any other company which paid dividends. Okay, so meaning that this other income, this which we have here, automatically is an investment income generated outside the group. So therefore, this one we can close the bracket and basically we include it there as an income. Is an investment income generated outside the group. And then you're told, number 6, all expenses and gain are assumed to accrue evenly throughout the year. No new equity shares were issued by any group companies during the year. Yes, I think that was to help us in terms of computing this. And then you're told interest on 5% bonds was payable in arrears. No payment had been made or provided for. Now, the reason why you're given that information in note number 7, I hope you can be able to recall what you are told in note 1. When the parent company acquired these shares in this subsidiary, the parent company paid 900 million. as per note number 1. So part of this particular amount, as per note number 1, was paid in cash, an amount of 600 million. And then part of it, which is basically the balance, 900 million minus 600 million, 300 million. As per note number 1, sentence 3, we are told it was paid by issuing 5% bonds. So meaning that this company here issued some bonds to the shareholders of this company. So it means that when this company paid the interest on the bonds, part of it was supposed to be paid to this company, to the shareholders of this company. But basically what you're told is that no interest which had been paid or provided for. The reason why you're given that information is basically for you to know that this finance cost will not be having any adjustment. But if, for example, it was paid and provided for, you should compute the interest the parent company paid to this company, paid to the shareholders of this company. And because that is a payment within the group, you come and you eliminate it there. But in our case, take into account this company, W Limited had not paid or provided for that interest, no amount to be deducted here. And that means that that value will not have any adjustment. The final value will be 18.2. 18.2. 18.2. And I think in our case, basically we are done. No any other adjustments. So let's get the final values here now. Let's get the final values. But what is important as far as that question is concerned is basically how we account for discontinued operation. How we account for subsidiary which has been fully disposed. So that is what is important for you to understand as far as that question is concerned. If you check on the other question we did, it was a partial disposal. Yes, in case of partial disposal, you basically combine the result of the parent with that subsidiary up to the date the parent company lost the control. But if it is a full disposal, you have to show the result from that discontinued separately here. Compute the gain or the loss on disposal of shares, and then you compute the profit, which was reported by the profit or loss reported by that company. Show that separately here. Yes. So let's get the final values here for revenue. 976 plus 63 minus 15. Minus 15. This basically gives us 1024. The cost of sales, we have 687 plus 26.2 minus 15 plus 3. And basically I'm getting 701.2. Is there even a need of computing the gross profit? Gross profit to natural that one. We say these figures are not marked. These figures you get after adding or deducting, you can just leave them. You can just leave them. So then from there, let's move and compute the operating expenses. Any adjustment for this? No. 68 plus 13.4. This one will give us 81.4. But what we said is very, very important. Whenever you're recording an expense there, ensure that it is inside the bracket. But if you record it as a positive, that one will be marked as an income. That one is wrong. So all expenses must be shown as negatives inside the bracket, but incomes, they must be positive. Yes. So no need of computing that, no need of computing that. Yes. I think that question now, if you leave it now at that point, basically will have, you'll get all the marks. You'll get Check in the class WhatsApp group. So once you get the question, please confirm. Once you get the question, you confirm. I've shared that question in the class WhatsApp group. Yes. Okay, confirmed by Rin there. So let's look on that question. It's basically a question on leases. A question on leases. So what are we told here? What are we told? What are we told here? Yes. So the question is that on the 1st of December 2020, Perry Limited entered into a contract to lease an item of machine from supplier for 4 years. So the terms of the lease were that Perry Limited was required to pay annual rent of 1.55 million in arrears, commencing that year of November 2021. Initial direct costs incurred on the lease amounted to 429,570 and were paid by Perry Limited. So the machine had a remaining economic useful life of 6 years at the commencement of the lease, and then you're told the lease did not contain any purchase option for the lessee. Did not contain any purchase option for the lessee. And then you're told the interest rate implicit in the lease was 13% per annum. And then you're told the present value interest factor of annuity PVIVA at the rate of 13% for 4 years is 2.97447. So what are we required to do here? We're required to analyze the accounting treatment of the above list transaction in the financial statements of Perry Limited, for the year which ended 30th of November 2021 or the year 2024. So basically, these are very good questions on leases. These are questions are borrowed from another paper, called FSA, Financial Statement Analysis. This is a paper which is done in CIFA. And basically, this was a question from April of 2025, specifically question number 5B. Now, in this case, we are told that this company, which is called Perry Limited, entered into a lease, and this company, Perry Limited, leased an item of machine from a supplier. So automatically, Perry Limited is the lessee, is the company which was given the right to use an asset, whereas now the supplier is the owner of the asset. So if you go to the requirement, you're required to analyze the accounting treatment of the above this transaction in the financial statement of who? Of Perry. So in other terms, you're required to illustrate how Perry Limited, who is the lessee, was supposed to account for this particular risk. And remember what we said is that once a company leases an asset, so that company should recognize 2 items: the lease liability, the right of use asset. But remember, we also talked about 2 exceptions in relation to that. You may come across that theory question whereby you are asked to give 2 circumstances, 2 instances whereby the lessee will not be required to recognize the lease liability and also the right of use asset. So we talked about 2 circumstances. Number 1, we talked about a short-term lease. If you lease an asset for a short period of time, a period which is less than 1 year, you are not required to recognize the lease liability and the right of use asset. Number 1 is therefore where the lease is a short-term lease. Number 2 is whereby the lease asset is of a low value. If you lease an asset which is regarded to be of a low value, you are not required to recognize the lease liability and the right of use asset. But this company, Perry Limited, basically on the date the lease commenced, the company needed to recognize 2 items: the lease liability and the right of use asset. We said always we start by computing the lease liability. And basically we compute this on the date when the lease commenced. In other terms, we compute this on the inception date of the lease. So if you go back to the information we have in the first paragraph, the first sentence, this lease was entered into on 1st of December 2020. That is when this company, Perry Limited, leased that particular item of machine. So we need to compute the lease liability. How do we compute this lease liability? We say that this one is equal to the present value of the minimum lease rentals not paid at the inception date. Not paid at the inception date of the lease. Inception date of the lease. Not paid at the inception date of the lease. So we discount those particular minimum lease rentals. but which were not paid at the inception date. So basically, if we go back to the information still which we have in paragraph 1, we are told that this company lists an item of machine for a period of how many years? For a period of how many years? Are we given? Yes, for a period of 4 years. I hope you can see that in the first sentence. So this therefore is that is for how many years? Is that is for 4 years. Year 1, year 2, year 3, year what? Year 4. So how are the minimum lease rentals payable? As per the information we have in sentence number 2, we are told the terms of the lease were that Peri Limited was required to pay annual lease rentals or annual rentals of 1.55 million in arrears. In arrears means what? At the start or basically at the start or at the end of the year. Who can tell us? In arrears means what? At the start or at the end? At the start or basically at the end? Yes, in arrears means at the end. So this amount was payable at the end. So the amount which was supposed to be paid at the end of year 1 is 1.55 million, 1.55 million. At the end of year 2, at the end of year 3, 1.55 million, 1.55 million. And therefore, if you check this particular question which you are doing here, you should be able to note that it is different from the other question which we did. I hope you can remember the other question which we did in class the other day, a question which was examined in December 2024. So remember the lease rentals, the minimum lease rentals were payable at the start. So therefore, I want you to see the difference. Rin, I think there was a question which was asked by Rin. There was a question which was asked by Evans. So in terms of the difference, whenever the minimum lease rentals is payable at the start and also at the end, we say there is a difference in terms of how we compute the lease liability. Number 2, how we prepare the lease amortization schedule. Remember, therefore, all these particular amounts are payable at the end. So how do we compute the lease liability? We discount the minimum lease rentals not paid at the inception date. Now, this amount, all of them, you can see they were not paid at the inception date because there is no amount which was paid there. Because we said we discount everything excluding the amount paid at the inception date. So we will take 1.55 million. We multiply this with the present value interest factor of annuity at which rate? At the rate of 13%. At the rate of 13%. The rate of 13%. Then what will be our N here? Our N will be 1, 2, 3, 4. So we are discounting minimum lease rentals for how many years? For 4 years. That's yes. So for 4 years. But remember, if this particular amount were payable in advance, so for example, this amount was paid here at the start of year 1. This was paid at the start of year 2. This was paid at the start of year 3. And this one was paid at the start of year 4. What would be the difference? The difference would be our N here. Our N should be 3. Our N should be 3 because we just need to discount what was paid there, and there. So the amount paid at the inception date should not be discounted. Sasa, yes. So let's work out this. And I think in our case, we already have this value. We already have this value. Remember, we said, in case the examiner has not given you this is the formula you have to recall. 1 minus 1 plus r raised to power negative n. We divide that with r. So that is the formula you need to remember. But I think in our case, we already have this value here. In the last paragraph, you're told the present value interest factor of annuity at 13% for 4 years. This one is given as what? This one is given as 2.97447. So if you work out this using this particular formula, you have 1 minus 1 plus r. Remember, our r is 13% raised to power negative n. That is 4. And then you divide that with 0.13. You should get that value there. You should get that value there. That's yes, we multiply that with 15. 50. So what would be our lease liability here? What would be our lease liability? What would be our lease liability? We try to hurry up so that we do at least more questions. What are you getting? So I'm getting a value of 4610. 428.5. Yes, so basically that is the value I'm getting. Yes, I think we can work with that figure right now. Yes, so that basically would be the lease liability. Now we said, even before we move to compute the right of use asset, what do we need to do with this lease liability? We need to amortize it. Before we proceed to compute the right of use asset, can we amortize this? So let's amortize this by basically preparing there is amortization schedule. There is amortization schedule. There is amortization schedule. So you'll also be able to see that there is difference in terms of how we're going to prepare this with what we did in the other question, simply because these minimum lease rentals are payable at the end. So take into account our lease is basically for 4 years. We need to have 4 years here, or you can have the specific dates when those 4 years were ending. So those specific dates are given in the requirement. If you go to the requirement, so you'll be able to see that you're given those specific dates. The first year ended 30th of November 2021, 30th of November 2022, 30th of November 2023, and 30th of November 2024. So then the next column here should be for the lease liability at the start of the year. The next column will actually be for the interest. The next column will be for the interest, and this one we computed at the rate of 13%. But remember, if these minimum lease rentals were payable in advance, so after the lease liability, the next column should be forward for the cash paid, for the minimum lease rentals paid, if this one was payable at the start. Sasa? Yes, but because it is payable at the end, so the next column should be for the interest. The next column should be for the minimum lease rentals, paid. And finally, we have the lease liability at the end of the year. So that's basically how we arrange our lease, the lease amortization schedule. And therefore, you can see always we interchange these two columns, depending with when the minimum lease rentals is payable. Can you be able to see that difference with what we are doing here and the other question which we did in class? Rin, can you be able to see the difference? Evans, can you be able to see the difference? Yes, I want you to see that difference. There is always a difference in terms of how we compute this one. There is the lease liability, and actually how we do what we present this. So in case the minimum lease rentals is payable at the end, so after the lease liability at the start, what comes next is the interest, and then the minimum lease liability. Yes. So what we start with here is basically the lease liability at the start of year one, and that is basically what you have computed there, which is basically an amount of 4610 or 28.5. So we compute interest, which will be 13% of this, 13% of the opening balance, 13% of this, and basically I'm getting 599, 356 to the nearest whole number. Let's work with that to the nearest whole number. And then the minimum lease rentals, which was paid at the end of year one, is this one, 1550,000. So this one we said it reduces the value of the liability. So to compute the lease liability at the end of year one, we will take this one, lease liability at the start of year one, we add the interest, we minus this. So in other terms, to compute this, we are taking what? In other terms, to compute the lease liability at the end, we are taking this one, the lease liability at the start, we are adding this one, the interest paid, we are raising the minimum lease rentals paid. So we are taking A plus B minus what? Minus C. Minus what? Minus C. That's basically how we are getting that value there. Sasa? Yes. So let's work out that. So we add 4610, 428.5 minus 1550. Yes, and basically here I'm getting what? I'm getting 36, 59, 784, 784.5, or let's just work with this to the nearest whole number. Let's just work with that to the nearest whole number. To the nearest whole number, to the nearest whole number, to the nearest whole number, to the nearest whole number. This one should be 9. Eh? Let's work with that. It's 9. To the nearest whole number, it should be that. Eh? Yes. So that will be the opening balance here. 3659, 3659, 785. So we compute interest, which is the 13%. 13%. Basically, I'm getting 475, 772. So the amount which was paid at the end of year 2 is this one, which is 1550,000. And then we compute the lease liability at the end of year 2. So we have 36,59,785 plus the interest for 75,772 minus 1550. Yes. And what are you getting here? My figure automatically is not correct here. Yes, what are you getting? Yes, 25,85,557. Yes, so that will be the opening balance here. 25,85,557. So we compute the interest as 13%, which will give us 336,122. The amount paid is 1550,000. Yes. So let's work out the lease liability at the end of year 3. We have 25,85,557 minus 155. Yes, and basically here I'm getting 13,71,679. 679. I hope that is what you're getting. So that will be the opening balance here. Is the opening balance here. And then we compute the interest as 13%. 13%, and basically I'm getting 178,318. So the amount paid there is 1550,000. And automatically this one should give a 0 or a figure which is insignificant. So let's see what we have. 178,318. Yes, 1371,679 plus 178,318. Yes, so I hope you can see this coming for around 3, but essentially it should be 0. Should be 0. The reason why you're not getting 0 is because of rounding off. So therefore, that's basically how we prepare that particular lease amortization schedule, basically to amortize our lease liability. Having this 10, we need to move and basically we compute the right of use asset. The right of use assets. And basically the right of use asset, equally we compute this at the inception date of the lease. Remember, the lease commenced on 1st of, this one should be December. It should be December. 1st December of 2020. That is when we are computing the right of use asset. Now to compute the right of use asset, we said we add like three values. Number one, we take the lease liability. The lease liability at the inception date. And basically that is the inception date is 1st December 2020. So, and the lease liability at the inception date is what you have computed here. 4610, 429. To this we said we add any payment made at the inception date, of the lease. Do we have any payment which was made here at the inception date of the lease? In our case, we don't have any payment which was made at the inception date. We say that you can only have that payment which was made at the inception date, whereby these minimum lease rentals are payable in advance. So if it is payable in advance, automatically the amount was supposed to be paid at the start, at the inception date of the lease. And then to this we add what? Initial direct costs, which are associated with what? With the lease. The initial direct costs associated with the lease. And I think in this question here, we have some initial direct costs which are associated with the lease. Can you see that? Initial direct costs associated with the lease. Who can be able to see that value? It is within paragraph 1, the last sentence. Can you be able to see this? Abdinasil? Amos, can you be able to see that? Yes. Yes. So the initial direct cost associated with the lease is 570. So we add those two values and we get now something called the rate of use asset. The rate of use asset. So the rate of use asset will be 4610, 429 plus 429, 570. And basically we get what here? we get 50. Okay, I think we can work with this one as 0.85, though you can't be penalized for that. So that will give us 50, 39, 998.5. Is that what you're getting? Is that what you're getting? 50, 39, 998.5. Yes. So having that, then, the next thing we need to do is basically to compute the depreciation per annum. Remember, we say that this right of use asset should be depreciated on a straight line basis at the shorter of two periods. At the shorter of two periods, the shorter of two periods, the shorter of two periods. Number one, the lease term. The lease term basically is the period of the lease. In our case, we know this is the lease for 4 years. And number two, the remaining useful life of the asset, or the remaining economic life of the asset. So we're given that in paragraph 2, we are told the machine had a remaining useful life of 6 years. 6 years. So out of the two period, we take the shorter of the, or actually we take the period which is shorter, which is basically 4 years. So we will depreciate this on straight line basis for 4 years. So to compute the depreciation per annum, we will take the right of use asset 50, 39,998.5. We divide that with 4. We divide that with what? We divide that with 4. So we have 50, 39,998.5 divided by 4. Divided by 4. And basically this will give us depreciation of 12,559. 1259 to the nearest whole number. To the nearest whole number, I think should be 1260. Is it 1260? Yes, 1256,000. To the nearest whole number. To the nearest what? To the nearest whole number. To the nearest whole number. To the nearest whole number. Yes. Now, that basically what is required. But if you check on what the question is requiring, we require to analyze the accounting treatment of this in the financial statement. We said, in such a case, what you need to do is you prepare financial statement extract. You prepare the income statement extract. You show what was supposed to be recognized there in relation to these risks. So we start by preparing the income statement extract. We start by preparing income statement extract. Income statement extract. And remember, you say that in the income statement extract, what the company is supposed to recognize, 2 items. One, we have these interest. And actually, we say that this interest should be recognized as part of the finance cost. Number two, the company should recognize this particular depreciation. So, and actually, we are going to prepare this for these 4 years here. The first year ended that year's November 2021, that year's November 2022, that year's November 2023, that year's November 2024, like that. 4 years. So at the expenses, our company will recognize 2 items. At the expenses, so we have these interest. You can just refer to it as interest, or you can just include it here as part of the finance cost, because that will be a finance cost. So this will be the interest for the first year, 599, 356. So for year 2 is this one, 475, 772. For year 3 is 336, 122. And basically this one is 178, 312, 318. Yes, the other item which will also be recognized here is basically the depreciation on the right of use asset. The depreciation on the right of use asset, whatever you have here, this one. And basically this one remain the same for 4 years. 1256,000, 1256,000 fair, 1256,000 fair. Yes, so that is basically what our company here was supposed to recognize in the income statement as far as this is what is concerned. So these are basically the values which will be matched. Remember, we have said whatever, or actually we said whatever you have done here, all these are workings. What earn you the max is what you have here. Yes. So therefore, you must ensure that you have prepared these financial statement extracts. So then from there, we can prepare the statement of financial position, statement of financial position extract. Statement of financial position extract. Extract. Equally, we will prepare these basically for 4 years. That year, the November 2021, that year, the November 2022, that year, the November 2023, that year, the November 2024. 2024, like that. Now, here in the statement for financial position, how many items will be recognized here? 3 items. One of it, David, automatically the figure which you have in the 1250. That will give us what? 1260. The 1260, yeah? To the nearest whole number, David. It's what 1260. Is that the position? Yes, I think this one should be 1260. Huh? It should be 1260. Like that. I think that should be the correct value. Is that the case? 1260? Yes, 1260. I think it is our rounding off, which is basically along here. But basically should be 1260. 1260, yeah? Yes, 1260 like that. Yes. So basically 3 items to be recognized here. One of which is the right of use asset. Now the right of use asset, that one we recognize it as part of the non-current assets. So under the non-current assets, we will have the right of use assets. The right of use asset. Now the right of use asset, we recognize it here at the net book value. So to compute the net book value for the right of use asset, we will take the cost, this one, and then we less depreciation for year 1. When it comes to year 2, we take this one minus depreciation for how many years? For year 2. Forward for year 2. No, you don't need to show that as provided you have recorded that as expenses. RIN, the person who is marking that will be in a position to see that those are expenses, provided they are at the expenses, because these are an extract. That's an extract. Yes, let's compute the right of use asset, the net book value. So we take the cost, which is 39,998.5, and then we minus the depreciation for the first year. This is the depreciation for the first year, which is 1260 x part 4. And basically that will give us what? Will give us will give us 37, 79, 99. Okay, to the nearest number, it will give us something like that. So then year 2, we also do the same. In year 2, you can take this minus that depreciation. Are we together? Yes. So we take, alternatively, you take this minus depreciation for 2 years. But the easy approach is once you have computed the net book value for year 1, to get the net book value for year 2, you take the net book value at the end of year 2, at the end of year 1, sorry, you less the depreciation for year 2. Sasa? Yes, so we will take this, we less depreciation for year 2, which is 1260 x part 4. And basically that will give us 25,19,999. What about there? So we take that value, we less depreciation for year 3, which is 1260. And that will give us a 1260,000. And then here, the net book value will automatically be 0 because it is this minus that. So that's how we compute the value for the right of use asset. Then from there, we said that this particular lease liability, this one should be recognized in the statement of financial position as a liability. But basically, we said this amount has to be split into 2. Part of it will be recognized here as an non-current liability. So under the non-current liability, we will have the lease liability, and still under the current liability, under the current liabilities, we will also have what? The lease liability. We will also have the lease liability. I think I showed you how to split that, how to determine the amount to be recognized under the non-current and also under the current. We said, I think whatever is very simple is first of all to determine the amount to be recognized under the non-current liabilities there. Under the non-current liabilities there. So we said the amount to be recognized as a non-current liability at the end of year 1, that is this year, we take the lease liability at the end of year 2. So the amount to be recognized as a non-current liability in year 2, we take the lease liability at the end of year 3. At the end of year 3, we take the lease liability at the end of year 4. At the end of year 4, the lease liability at the end of year 5. So therefore, in year 1, the first year here, the amount to be recognized as a non-current liability is this one. So which is 25, 85, 557. In year 2 is what we have here, 13, 71, 679. In year 3 is basically 0, and also in year 4 is 0, like that. Sasa, yes. Then from there, to determine the amount to be recognized as a current liability, we say this amount payable within 1 year. And therefore we said we take the decrease, because the decrease basically is the amount which has been paid. The reason why liability reduces is because there was a payment which was made. There was a payment which was made. So let's get the difference here between these two values here. We have 36, 59, 785 minus 25, 85, 557. And basically we have a decrease of 10, 74, 228. I hope that is what you're getting. David, the writer, is that what you're getting as the decrease, as the difference between those two values? Is that what you're getting? Yes. So then we move to year 2. Year 2, basically we get the difference between these two values here. The difference between those two values there. That is the 25, 85, 557, 25, 85, 557, and this one, minus 13, 71, 679. So and basically that will give us an amount of 12, 13, 878. Yes.